In the past lectures, I have introduced the history of financial risk management, and we focused on how market risk management was done. Today, I'm going to move to the next big topic in financial risk management by giving you a one lecture overview of credit risk. As we saw when we studied the taxonomy of financial risk, there's many different types of risk. There's market risk, credit risk, liquidity risk, operational risk, and many others. This is going to be the second and last description I will give on the taxonomy of risk management. Credit risk. Credit risk, I remind you, is the type of risk that one will experience when your counterparties do not do what they are supposed to do. Market risk was the losses you can experience when the prices change. In credit risk, the prices don't need to change. Your counterparties need to change. Your counterparties will not do what they're supposed to do. They will not pay. They will go bankrupt. They may get into financial difficulty, therefore decreasing the value of their obligations to you, and so on and so forth. In dealing with this, I want to be very practical. Today I want to be very practical. So practical that I want to start with two business cases. One which happened at the very beginning of when somehow credit risk was taken seriously by the financial sector. And the second is one that we've already seen that today is going to come into a new light. This original case is the case of the Goodrich Rabobank swap of 1983. Describes very well not only how a credit risk works, but also how it developed. It was a very particular period of time that involved a very particular company, B.F. Goodrich. And this is I'm going to spend some minutes on this business case. It's really worthwhile because it'll help us understand credit risk from a very practical perspective. And then we will develop the finance and information management tools needed to understand it. So let me first talk about the business. B.F. Goodrich was a tire company. What they did was mostly tires for cars and trucks and vehicles. And today they don't do that. Today they've switched into aerospace manufacturing. Back in 1983, what they did was mostly tires. And I'll explain the context of that. The other player that we're going to be dealing with is a Dutch bank called Rabobank. It's a financial services company who had just desired to enter into the euro-dollar business. Part of their business was to manage the pension of Belgian dentists, for example. So they had a pension business, which is going to be very relevant for us today. So these were the two major players. They did not know of each other. I mean, they knew each other, but they did not deal directly with each other. They had a common consultant that was Salomon Brothers, who was advising them on what mattered to them, which I'm going to describe. For Goodrich, the issue for them was financial difficulties. They had just been downgraded to BBB-. Today we're going to understand what this means, but I'm assuming you have some working knowledge of what a credit rating is. A credit rating is a designation given to you by an agency called a rating agency. If your rating is high, that means you're good credit and people want to do business with you. If your rating is low, bad, then companies don't like to do business with you. And if they do, they will charge you more for that. Similar to individuals, except individuals are not so, the process for individuals is not, is actually quite different from for companies. And we're going to see that today. In fact, we've already seen that in previous lectures. I'll remind you of that in a few minutes. So B.F. Goodrich was in financial difficulties. The reason for that are historical and very important. car sales were down, but this is an understatement. 1983 was actually 1982. 1982 was a year of tremendous financial difficulties in the world. As we're going to see, the context was a very prolonged recession with very high interest rates. To understand the significance of that, if you know a little bit of economy, you will know that typically when you're in a recession, rates are low because central banks lower the price of money to help with recovery. In this case, that was not the case. Inflation had been very high. We were still suffering from the aftershocks of the US-Iran oil embargo that we discussed some lectures ago. And the consequence of that was a crazy, absolutely unsustainable situation of a recession with very high interest rates. When that's the case, what are you going to do? What people that need cars, what are they going to do? Car financing was difficult to get. Therefore, people, companies, individuals, they delayed the purchase of new cars as much as they could. That led to a decrease in car sales and therefore a decrease in tire sales. And this hurt Goodrich significantly. With interest rates of 11% during a period of recession, you can imagine how painful that was. You probably know that rates right now are about, depends on where in the world you go, 2-3%, something like that. And we are in a period of reasonable economic growth. If you have a shrinking economy with 11% interest rates, that's very bad news. It's very hard to recover from that. So the recession, high interest rates, all contributed as a double whammy to the decrease of car sales. So that's how bad things were Goodrich. A company that had profits of about $50 million per year turned into losses of about $50 million per year. Actually, they were about $33 million, but that's about it. They were looking for $50 million of fixed rate financing. This is what's important for us. Under these financial difficulties, Goodrich was looking to finance their operations with $50 million of fixed rate loans. What does fixed rate mean? Fixed rate means that they agree on the rate and the rate's there for a long time. 5 years, 8 years, 10 years, something like that. Okay? We'll see the significance of that later for the financial interests. However, note one thing, which is that if interest rates are at 11% and you are in a recession, if you're going to obtain financing at a floating rate, means that if you leave the recession, then you're going to be probably rates will go even higher up. And I suspect, I don't know this for a fact, but I suspect Goodrich was making the calculation that fixed rate was what would minimize their future risk as they get out of this recession. On the other hand, Rabobank, it was a financially very strong bank, rated AAA, very as good as it gets. And they were part of their business was a pension plan management. If you're a pension plan manager, then you're benchmarked to inflation, for example. You're benchmarked to inflation. That means that in their appetite to make investments, they look for investments that have a variable rate of return, not a fixed rate of return. A fixed rate of return typically does not match inflation, which can give rise to a mismatch between their asset liability management. So they were interested in a variable rate yield for their money. Okay, and they had a common consultant, Salomon Brothers. But let me summarize the situation, the market situation for both of them as follows. This is what's interesting too. This is the key to the whole business case discussion today. When Goodrich went out to get their fixed rate financing, what they found is that because of their poor credit quality, they could only get a rate, fixed rate, that was 12.8%. However, if they had been interested in a floating rate, they could get a better deal, which was Fed fund rates plus 50 basis points. Now, what are Fed fund rates? They were about 11%. So you see the difference is it essentially is 11.5% on a floating rate versus 12.8%. What they wanted was the expensive solution. The cheap solution is not what they wanted, and that was a problem for them to decide what to do. Okay, it's the same problem I have when I go shopping. What I like is what's expensive, and the cheap things is not what I want. What happened to them is what happened to me, and what happened to most people, right? So let's leave that aside for a minute. Let's look at Rabobank. Rabobank, its credit quality was so good that it basically didn't matter if they went for fixed or floating. They got more or less the same rate. I'm going to assume that Fed funds were about 11%. So for Rabobank, it didn't matter, but for Goodrich, it mattered a lot. So what do you do in this situation? What you do in this situation is you propose a deal. You're going to convince Goodrich to get what they did not want, but was cheap, which is to get financing at a floating rate. It's not what they want, but it's cheap. So they're going to get that funding. You're going to convince Rabobank to get what they did not want, not because it was cheap or expensive, because it was the same price, but because it's the opposite of what Goodrich will get, but it's exactly what Goodrich wanted. Because now, once you have that, then you're going to what's called swap. You're going to change these payments from one to the other. You're going to set up a trust, what's called a Morgan Guarantee Trust. This is essentially a company that is going to act as a paymaster to do the following thing. It's going to enter into an agreement with Goodrich to exchange payments in the following way. Okay, note that the two arrows. The payments will be exchanged as follows. Every so often, let's not look into when, every so often, the Goodrich will pay a fixed amount of 11% to the Morgan Guarantee Trust, and is going to receive whatever fund rates are back from a Guarantee Trust. Okay, the Fed funds are going to have a small discount, which I'm going to denote by the number X right now. Okay, so now let's look at the Goodrich side of things. There's three arrows in Goodrich. One of it, two of them point out and one points in. If you look at the arrows that goes from just here, if you look at, I'm gonna write this down on the screen. This is something that you need to understand. This is what's important to understand. If you look at this, arrow, this is payments that they're gonna get from Morgan Guarantee Trust every so often. And that is going to essentially match the outgoing payments as the Fed funds go up and down. You see, they have the same risk factor. We already studied risk factors earlier. So that means that these two arrows with the dotted lines are going to cancel each other out, and what is left is 0.5 minus X%. Fixed. All the floating variables have gone away. And then we add the fixed rate line here, which means that essentially Goodrich is going to pay 11 plus 0.5 minus, plus X%. Okay, this should be plus X because it's money coming in. So this is what Goodrich is going to end up paying once you take into account the netting of all three lines hitting Goodrich. And this is what Goodrich wanted, because this is fixed. The Fed rate component, which is variable, has disappeared. You see that? So this is a loan, and this is called a swap. So the loan with the wrong rate plus the swap becomes a fixed rate loan, which is what Goodrich wanted. So that's good. Goodrich was kind of happy because of that. Now let's look at Rabobank. The Rabobank side of the deal is going to be as follows. They're going to get what they did not want. They did not want that. But this, with that, we can see that they again cancel each other out, because they receive 11% and they give 11%. So the net result of that is that these two, they kill each other out. And what is left is this one, which is a floating rate exposure to interest rates. A Rabobank is going to have a certain investment that is going to draw them variable rates every so often. So this is great, because you get Goodrich to get what they did not want, you got Rabobank to get what they did not want, and then these two swaps, what they do is they turn what they did not want into what they wanted. And why would they do that? Well, they would do that for the following reason. Note that here, Rabobank is going to pay a little bit less than it would have to pay to the market. So the Y, this number is the incentive. This is the incentive for Rabobank to get into this deal. They could have done this on their own, but by going through this, they end up saving a little bit of money. Why would Goodrich do this? Well, Goodrich would do it because we already saw that the whole cost of this was Fed plus 0.5 plus X. And as you see, it's a little bit more than what they could get, but once you get rid of the Fed, eventually this became 11 plus 0.5 plus X%. So as long as this is less than 12.8%, they're making money. So that means that I have here, X could be any number. If X is smaller than 1.3%, this is a good deal for Goodrich. They save money. And now finally, how would Morgan Guaranty Trust, why would they do it? Well, they would do it because if X is bigger than Y, then Morgan Guaranty Trust makes X minus Y% return. So everybody makes money in this structured deal. You understand that? This is very interesting to understand, because this is finance. This is not information management yet. This is not credit risk. This is nothing. This is finance, just finance. So do you understand that? I would like everybody to understand this. It's a very interesting deal from a financial perspective. So again, to summarize, as long as X is bigger than Y, and as long as X is smaller than 1.3%, everybody makes money here. Okay, so let's do that. Now, what's the problem? This looks too good to be true. What is the problem? There's one problem. There's one small problem. If the difference that we have for X is pretty healthy. It's about 1.3%, which on a $50 million loan is about $650,000 per year. That's how much money this deal will make. It's pretty good. Let's see what everybody wins here. A Rabobank will win X. We went through that. Morgan Guaranty Trust will win X minus Y. And Goodrich will win 1.3% minus X minus Y. So this is a good deal for everybody as long as these conditions are met. But let's look at the difficult, challenging part of this deal. What happens here? This is what the problem lies. The problem here is that if rates go up, BF Goodrich credit quality will go down. What happens if Goodrich does not pay? Morgan is going to lose money when Goodrich goes bankrupt. So in the previous deal, we said it was a good deal because we assumed everybody was doing what they were supposed to do. But credit risk is about that not happening. If Goodrich goes bankrupt, then Morgan Guaranty Trust is not going to collect the payments from Goodrich, but it still has to make the payments to Rabobank. That's the problem that we have here. And now we try to understand that problem. That problem is called credit risk. There was no credit risk on the Rabobank side because Rabobank was going to pay. It's a very, very good credit. There was no concern with Rabobank paying. The concern is with Goodrich paying. So let's study that a little bit. If interest rates, let me ask you a question, and this is for you to think. From Morgan's perspective, Morgan Guaranty Trust perspective, what's the problem? The problem is it that interest rates go up or that interest rates go down? What are they concerned about? They are concerned with interest rates going down. If interest rates go up, they have to pay money to Goodrich. The net is an outflow. So they don't care if Goodrich goes bankrupt because they have to pay Goodrich. If rates go up, they have to pay Goodrich. It's not the concern. The concern is if rates go down. If rates go down is when they expect to receive money from Goodrich. If Goodrich defaults, if Goodrich goes bankrupt, when rates go down, Morgan has a problem. Only then Morgan has a problem. So the whole risk of this operation is that Goodrich goes bankrupt when rates go down. Okay, but if rates go down, what will happen to Goodrich? We think that if rates go down, car sales will pick up again. Therefore, Goodrich is going to be less likely to default. So there's a very nice alignment between the credit risk profile of this transaction, which is to Goodrich defaulting, and the exposure of this transaction. The exposure of this transaction is how much money we should pay Goodrich. Sorry, the exposure of this transaction is how much money we get from Goodrich. That's the exposure. What we pay Goodrich, we're not concerned because Goodrich is the party with a probability of default, and therefore our concern is that they have to pay us money. That will only happen when rates go down. But if rates go down, we are somewhat certain that Goodrich's probability of default will go down. Therefore, we'll be less concerned. Is this clear? This is the important part to understand in this whole deal. This contributes to a low risk profile for this particular transaction. Is this understood? This is just finance for now, okay? Finance with an overlay of credit considerations. Is this clear? Clear. Okay. So if this is clear, here we learn a few things about credit risk. On the one hand, credit risk and market risk are going to be related somehow. As you can see here, when rates go up or rates go down, our considerations for payments are different. There's another thing, which is that from a market risk perspective, Morgan, if you only look at the swap with Goodrich, would be concerned when they have to pay money. That's when you lose money. In credit, that's not your concern. Your concern is when you get money. That's your concern. So credit and market, sometimes they go in opposite directions. The considerations are opposite to each other. That's another thing that we learn. What I will do today is I will design the framework needed to understand these types of considerations. I'm going to design a fairly intuitive framework. We're going to have to develop some mathematics to do that, and that's the objective that I will do today. And I may, in fact, I will come back to this deal several times because it's going to be a very good source of inspiration and problems for us to solve and understand how credit markets work. Now, let me go back to another example that we already saw, and I want to make a connection with this one that we just explained here. This is the Scotiabank Cencosud deal that happened in Chile. So I remind you, a Canadian bank, the Bank of Nova Scotia, did a deal with a Chilean supermarket, the result of which was that Scotiabank could create a credit, micro or mini credit line of business in Chile. And the way that worked was it reached the deal with the supermarket so that every customer of the supermarket could apply for a credit, a line of credit of up to $300 at the checkout counter. And once that request is made, the supermarket shares with the bank somehow the customer profile. The bank gets some information and makes a decision within 5 seconds whether they will give the loan to the customer or not. So this is we discussed this earlier. This has some very interesting features, which I'll describe in a minute. But note one thing, which is that what this example shares with the previous example that we discussed is the same credit risk. Credit risk is credit risk in the previous example measures what I should worry about when I deal with Goodrich, and here it measures what I should worry about when I deal with my customers in Chile. Now, this is an entirely different proposition to the one that we saw earlier. This is what's called retail credit, whereas the other one is institutional credit. Today, I'm going to talk about institutional credit, which is the one for which we have some framework for making decisions. Retail credit is different because it's just essentially an exercise in data science. And that's how this thing is done today. I remind you, things that we saw, that Scotiabank, because of this deal, became the third largest lender in Chile. That was fantastic, with a very simple deal. They did this without branches, without staff, and with regulatory advantages associated with the fact that they did not even need to have bank accounts for people there. They deal directly with the supermarket. Okay? And this is, as we also reviewed in another lecture, one of the proofs how metadata is so useful for finance. And I mentioned this just to remind you, but also to say that this is something which I'm not going to cover today, because today I'm going to be dealing with financial models and not with machine learning models. Okay, the metadata is something interesting that we don't see in the institutional world, where we could cross-reference data coming from different business lines. In the case of supermarkets who already have banking clients, the relationships between commercial lending and retail lending, and you can understand relationships between shopping patterns, family relationships, These are things that we already discussed. Very different approach from what we have seen in the Rabobank Goodrich deal. Okay, so at this point, I just showed you two ways of doing credit risk. One which is about to begin, and I will be developing the models for that. It's going to be a financial model. This one has finance in it, but it's really not a financial model. It's a data science model, and I'm not going to talk about that one. I'm going to talk about the financial model that we're about to discuss, the one linked to Rabobank and Goodrich, not the one dealing with Scotiabank. Okay? Right. So, so let me, with this thing that we have learned, let me address the concept of credit pricing. Let's try to come up with a way to understand the cost of making business in the credit world. For that, I'm going to do, first of all, cash flow valuation. And then I will pay attention to the concept of default probabilities. So the first one is going to be finance, and the second one is going to be probability theory, mathematical theories. And then that will turn into a credit process. And by the way, today, we're going to develop a financial framework which will end up being quite sophisticated, and I will use that as a way to justify some of the lectures that are coming later, which are going to be more sophisticated mathematically. And today will be my proof to you that these theories that will develop in the future are theories that we will need to know if we want to be able to deal with this complexity in the right way. In other words, the sophistication that I'll be doing, mathematical sophistication I will be doing in the next lectures, is not whimsical. It's not something that I do because it's entertaining or even nice. I'll do it just because it's needed. And today we're going to see some of the complex situations in which we can be in that justify the need for those theories. Okay, so today is going to be a step up in terms of not only our financial knowledge, but also in our need to have proper methodologies, mathematical methodologies to deal with complex financial situations. Okay, now having said that, I'm going to go back to something very, very easy, which is cash flow valuation. And cash flow valuation is something we already saw. And we saw a while ago that if I have cash flows in the future, I can value my cash flows with this formula. In this formula, what we have is we have a number of payments denoted by N, which we have here. We have an amount paid each time TI, so the time TI appears here, and the amount that's paid appears here. And R is the interest rate that we have for that particular term TI. And here I make the connection with something we already saw. Remember how we constructed the yield curve when we were trying to understand the price of time. So all of that has been developed, and it resulted in exactly this formula that you have here. So this is something which we have seen. The rate that we have here is instantaneously compounded. That's the reason why we have an exponential function and not just a power, because we're doing instantaneously compounded interest rates, which again, I remind you, are the ones which are easiest to work with when it comes to mathematical models. You can go from one to the other. They contain exactly the same amount of information, but in this case, the instantaneously compounded interest rates are just easier to deal with. Now, the thing with this equation, and the reason it's going to be our starting point, is that this is a situation where we assume that every payment will happen with probability 1. There is no default risk. The concern today is that every time a payment is due, you don't know if your counterparty will make the payment. That changes everything. It changes the price, it changes your expectations, it changes many things. And that is the perspective we're going to be adopting today. We're going to start with this. So again, if you have a number of payments coming to you in the future, and now we introduce the uncertainty whether these payments are going to be made, now we need to decide how to value all of this. How are we going to do that? Well, we're going to do that by introducing a number, which is the probability that each payment is going to happen. This is a number which ranges between 0 and 1. And if I use this number that denotes the probability that a payment will happen, then I would say, I'm going to propose to you that we could look at the valuation of my cash flows as follows. I multiply each payment by the discount factor, of course, but by the probability that this payment will happen. If the payment has a high probability of happening, then that valuation is going to go up. If the payment has a low probability of happening, the valuation is going to go down. Okay? Alternatively, if the payments are fixed, and then the value, the probability that I will get paid goes down, then the value of my payments will go down too. So all of that is predicated on this number, the number which is the probability that a payment will happen. This is a number which is a mathematical construct. We're gonna just leave it there for a few seconds, but I want to ask you a question, which is, actually, I'm not going to ask you a question. I want to remind you of something. I want to remind you that we've already been fooled once before into believing that probabilities can be used to price financial instruments. We had a 33-cent game, which I used to deceive you that the price to play that game was 50 cents, when in fact it was 33. You paid too much. So I deceived you in the past with probabilities. I could deceive you today with probabilities too. I just want you to remember that. So since we've already been here before, since we've already learned how probabilities are not to be used blindly when you're using finance, I'll just make one comment, which is that these probabilities that I'm taking here need to be risk neutral. We don't know what that means yet. We're going to know in a minute, actually in a few minutes. Okay? But I'll just mention that we've already learned that if the probabilities are risk neutral, then we can use them to price transactions. If they are not risk neutral, I can use them to mislead you into believing certain things. In perhaps they actually lead to the wrong price. So, what does that mean? What is risk neutral? Well, I'll remind you what risk neutral was. Risk neutral was the probability that was obtained from market variables. How we do that? Just wait, I will tell you. Just remember something we learned in previous lectures, that pricing transactions, financial transactions with probabilities will only work if they are risk neutral. Okay? All right. So leaving that there, it's gonna come back. I can now move forward and I can introduce the concept of risk neutral pricing. And the risk neutral pricing, what we need is the probabilities to be consistent with market prices. In doing this, I need to say a few things about default. Defaults occur only once. There's no such thing as defaulting twice. And the reason is, when a default happens, if you're a company, the company gets dissolved. If you recover as a new company. So the concept of default only occurs once. If you're an individual and you file for bankruptcy, then when you come out of bankruptcy, then you have a whole new record. So everything is different. In credit risk, we assume that a default will occur once and it's permanent. You do not recover from that. If you do recover from that, you recover as a different legal entity, not as the old legal entity. Okay? This makes it very difficult to do any type of historical analysis. Also, defaults are very rare. It's not as if you have companies default every month or something like that, right? So we have very small databases of defaults to make any particular theories, historical theories of default. So we don't do that. We assume counterparties do not recover from defaults; they become new counterparties. So we need to have a different approach to probabilities anyway, because we have no historical basis to make statements about probabilities. So in this case, the use of risk neutral pricing is not only something that we need to do for financial reasons, it's something that we need to do for data reasons, because we don't have data to do anything else. Okay, but again, I'll tell you in a few minutes how we are going to do this in practice. Before that, I want to speculate. I want to play a little bit with this concept of the probability, the credit spread, or the probability of solvency, probability of default, by introducing another term, which is the hazard rate. The hazard rate is the logarithm of the probability of solvency divided by time. I put a negative sign because this is a number which is always less than 1, therefore the logarithm is negative, and I want this thing to be positive. Okay? So this is the hazard rate. The logarithm of the probability of default, the logarithm of the probability of solvency divided by time. This is the time at which I'm considering being solvent. Now, why am I doing this? I'm doing this because this is a very, very, very useful, very convenient number. With this, I can rewrite my cash flow valuation formula as follows. Look what I did. I used to have a Q sub I there. But if the Q sub I is, I use this thing here, I can see that the Q sub I now becomes e to the minus HITI. So QI becomes that. So I plug that in, and that's the formula that I obtained here. This formula is fantastic because it's the same cash flow valuation formula that we had without credit risk, by simply increasing the interest rate payments I receive. In other words, the hazard rate is the interest rate, is the yield increase that counterparties will have to pay because of their credit quality. So the hazard rate is an interest rate. Okay? This is very, very useful. Such a useful term that has a special name. It's called the credit spread. Okay, we're going to play with the credit spread a lot. And in fact, as I'm about to show you, the credit spread is what will hold the key to understanding risk neutral probabilities. Okay, so what we see is that if your probability of solvency is very high, then your credit spread is very low. In other words, if your probability of default is low, your credit spread is low. And your probability of solvency is low, your credit spread is high, and your probability of default is high too. Okay. All right. So let me now give you an exam question. I want to give you some time to work out something. Imagine I give you this table. This is a table that is obtained from the market. We will see later how these tables are done. Okay? But for now, I just want to give you a problem. I want you to actually practice something. And this is an exam question. It's from the PRN, the Professional Risk Managers exam. I give you here a 1-year forward zero curve for counterparties of different credit qualities. Again, the credit qualities is something that I will explain in the future, in a few minutes. But I assume you have a working knowledge of what those are. And the question here is this: with this piece of data, if you have a double B rated bond, this one, that matures in exactly 5 years. It's a 5-year bond and pays an annual coupon of 6%. It asks, using this table, calculate the 1-year forward price of the bond if the obligor stays at double B. So I'm going to give you, I want you to try to do this. We've learned enough to be able to do this problem. I want to give you, 5 minutes? The way to do that is, if I have my bond is rated double B, it matures in 5 years, and it's paying an annual coupon of 6%, the 1-year forward price of that bond is going to be the first payment, 6 years forward is 6. That's the forward value of my $6 coupon payment that will happen in a year. And then the one after that, the 2-year forward, so the coupon in 2 years, 1 year forward is discounted with the 1-year forward curve, which is what I have in the table. Same thing for the 3-year, 4-year, and the 5-year. The 5-year, I use the 4-year forward rate to discount the $106 payment that will happen at maturity. And then I discount all of that. Here I'm using annual compounding or instantaneous compounding. That's the tape because that's the rate that was given to me, and the result is $102 and change. That's how you would do this. And the only row which is relevant in that database is the double B row. That's the only thing that I'm asked to do. Okay. Okay. Let me continue. Yes.
First, we would get the first coupon payment as well.
The first coupon payment is that one here.
Yeah, right. But does a forward include that always? Like
when
exercise
this,
like this?
The forward value of a $6 payment you will get in a year. The 1-year forward value of $6 in a year is 6.
Okay. Yeah. But I was wondering just if the forward holder will get the first coupon payment, or it will be after the first coupon payment date.
I don't understand.
So when you hold the forward of the bond and the coupon is paid, for example, we shouldn't get the coupon payment, right? If we are just a forward holder, we don't hold the bond. And when you're saying that what's the forward value of 1 year, should we include the first coupon payment or not? Because doesn't it matter when we'll receive the forward after the coupon payout or before the coupon payout?
I think, okay, I don't think I fully understand your question, but I suspect you're asking a mechanical question, which is how does the coupon payment, how is it made, right? And you're thinking that maybe I get the coupon, maybe the coupon payment is paid before I get the bond, is something like that? Is that what you're thinking?
Yes, that's right. That's what I'm thinking.
Yeah. No, well, since here we're only calculating the forward value, we don't have to worry about the mechanics. This is a bond. Whether you deliver that or not, the bond has a payment of $6, has a coupon payment of $6 in a year. So the forward value of that coupon payment is $6.
Right.
Whether you miss it or not, that is as a function of the sale. How do you find the sale? But the value, this is only asking about the value. The value of the coupon payment a year from now is $6. I'm now going to start to model how credit happens, and it's going to allow us to draw some very interesting conclusions. I want to use a very, very simple model. I want to assume that my counterparty can only be in one of 2 possible credit states. We've already mentioned how there's triple A's and double A's and single A's and this and that. Let's say only 2 possible states, solvency and default, okay? Now, before you jump to the conclusion that we're always in either solvency or default, yes, you're right. But I'm going to assume that related to this is the fact that the probability of default is constant over time. In other words, the probability that I go from solvency to default is always the same. I don't get better, I don't get worse. My credit quality does not improve, does not decrease. There's only two states, but these states are constant. The probability of changing from one to the other is constant, okay, equal to a number q. So I will assume that my probability of solvency for the rest of my life is going to be a number q, and that's the probability I will stay solvent. I'm not going to become more credit prone or less credit prone. So in other words, the probability I stay solvent at time t plus 1, conditional I was solvent at the beginning of the year, is q. These are all going to be annual probabilities. Okay? And this q does not change over time. It's not a q as a function of time, it's just q. Very simple model. It is not realistic, but it's very simple. And we're going to be able to draw interesting conclusions from that. The first conclusion I get from that is the following. Then I'm going to, I wrote it here, the probability of being solvent after a period of time t, wherever t is q to the power t. So think of it this way. Let's say that the probability I'm solvent for a year is q. What's the probability I'm solving for 2 years in a row? Is probability I'm solving the first year, q. Probability I'm solving for the year after, q times q, because it's a conditional probability, right? It's as if I have to take, if I flip a coin and I want to get 2 heads in a row, it's 50% times 50%, 25%. So the same thing here. The probability that I stay solvent after 2 years will be q squared. After 3 years, q cubed. After 4 years is q to the power 4. And this will generalize also to fractional powers. If I want to know the probability I'm solvent in a year and a half, is q to the power 1.5. Okay, you may have seen this. I should say one thing, which is this process we're beginning to see here. It's very simple. I can relate it to coins, but it is, for us, it's going to be the first non-trivial stochastic process we have seen. It's going to end up in a Markov chain. You may have seen Markov chains, and it's related to Markov matrices that we've studied in the past. But it's the level of sophistication of what we're beginning to construct is increasing. Today, I will still manage to do that in a controlled way. It will not be hard to understand. Everything I'll do today will be easy to understand. But as I mentioned at the beginning of this lecture, this is going to allow me to justify why our mathematical sophistication for dealing with stochastic processes has to improve. And I will do that. I will do that in a different lecture in the future. Okay? All right. Now, the important consequence of this statement we just derived, the important consequence that the probability of solvency at time t is this fixed number q to the power t, is that if I calculate the hazard spread, or if I calculate the credit spread, what I get is constant. I remind you that, I have to remind you that hi was negative log qi divided by ti, because qi is q to the power ti, logarithm of q to the power ti is same as log q times ti. This ti kills the ti, and the answer is that. This is a shocker. This is a shocker. What does that mean? That means that the credit spread I have is constant. It doesn't matter how much into the future I look. It's a constant spread. Not only is that surprising, but as you will see very soon, this is going to have tremendous consequences that are going to make calculations of credit spreads very, very easy, very, very easy. And it's going to allow us to calculate our first risk-neutral probability of default. That's how important this is going to be. Very simple model, but very, very relevant. Now, before I go into that, I want to be a little bit pedantic and I want to explain to you what I just said that I think you understand. I'm gonna express it in very rigorous mathematical language. So I'm gonna say the following. I have a Markov chain with only two possible states, solvency and default. What is a Markov chain? I assume you have seen Markov chains. If not, doesn't matter. I'm going to explain it to you. A Markov chain is it's a stochastic process that explains the evolution over time of something, some quantity that can only be in a number of fixed states. For us, there's only two, solvency and default. And the probability of going from solvency to default and default to solvency is given by a matrix. This is the transition probability matrix. It's read as follows. The probability I go from solvency to solvency is Q. The probability I go from solvency to default is 1 minus Q. It has to be because I have nowhere else to go. The sum of those two numbers has to be 1. The probability I go from default to solvency is 0. As I mentioned earlier, I do not recover from a default event. And the probability that I stay default if I'm at default is 1. So every Markov chain, they're all the same. They're all a number of states, 2, 5, 100, infinitely many. They're all the same. I have states in which I can be, and I go from one state to the other with a predetermined probability, which are always expressed as a matrix. And this matrix does not change over time. It's always the same. Okay, so this very simple model I just described, I'm going to express it as a Markov chain. Very simple Markov chain. And what I just showed you is that in a two-state Markov chain, the credit spread is a constant, equal to the negative of the logarithm of the probability of solvency over a 1-year period of time. Okay? Very simple. The only difficulty here is to understand the mathematical jargon that I'm using. But I'm going to expand this mathematical jargon very soon, and by the end of the day, you will all be very, very good at dealing with this mathematical jargon. Now, from the point of view of the term structure of credit spreads, just like we did the bootstrap of the yield curve, something that we did in a previous lecture, okay, we could do the bootstrap of the yield curve of any corporate. And I remind you what we did, so you see how easy it is to do that. How did we do the bootstrap of the yield curve for a risk-free rate, say a government? How did we do that? We got some bond prices, and then we fit the yield curve so that all bond prices are priced at the same time. That's what we did. If I give you bonds of a corporate and you do the same, you're going to get the yield curve of the corporate. So in this case, in this picture we have here, I would say the curve in blue is the result when you do the bootstrap for the risk-free counterparty, the Federal Reserve Bank, the central bank of your country, whatever it is, blue. But if I take a corporate, say a double B corporation, and I look at their bonds and I do exactly the same, I'm going to get a different curve. That curve has to be above the risk-free curve. Why? Because there's a probability of default, a non-zero probability of default. And we saw that a non-zero probability of default turns into a spread which is positive. All of this we have seen. And now what I just showed you is that in my simple Markov model with only two states, the spread that we see between these two curves has to be the same. So this picture that you're looking at cannot come from a two-state Markov chain. The two-state Markov chain is very, very simple, simplistic even. It's going to be wonderful for us because it's very intuitive, and I want you to be very good with it, despite the fact that it does not explain reality, but it gives you very good intuition. That's why I want to spend some more time with it. And then I'll tell you the real thing. Then I'll tell you how things work in practice. But for now, I want to develop your intuition with this very simple model. Okay? So when I say that the credit spread is constant, what I mean is that the difference between this blue and green curve are always the same. That's all I'm saying. Okay, so so you see how powerful it is. Let me apply this to understand sovereign risk. Sovereign risk is the probability that a country defaults. And I like to use Greece for this because I don't know what you were doing in the year 2015, 2011. These were very severe times for Europe. I will save you the details, but there was one particular country that was the target of a lot of speculation whether it was going to go and default, and that was Greece. The European Union has a very interesting makeup of its finances, which is perfect for my lecture. You have a number of countries, each of which have a different probability of default because the European Union does not provide security for each country. They have the same currency, but they don't have the same probability of default each country. Germany is typically considered to be the country which is risk-free. No one considers the probability that Germany will default. At least that's the way it is for now. It could change, but for now, that's what it is. So it allows us to look at countries, different countries, 27 countries, and their different ability or their different credit characteristics with regards to Germany. And that's why I use them. I could have used Argentina. Argentina is a country that has defaulted at least twice. I could use Spain, a country that defaulted in the year 17 something, but why would I do that? It was a long time ago. I don't have data. It's just not very useful. I could talk about Russia that defaulted in 1998, but that was a very strange default because they defaulted and then they devalued the currency, as we saw the other day. These are not very good examples. Europe is the best source of examples, and Greece, what happened in Greece is actually a very good example of that. And I'm going to use that to show you how powerful, how strong you are with this very simple model that we have developed. You're very, very powerful. Imagine I ask you, what's the probability of default of, say, your country right now? I'm going to show you how you can do that. You can calculate that in a risk-neutral way. And not only that, you can calculate the risk-neutral probability of default of just about anybody who has bonds. Anybody who issues bonds. That's how strong you're going to be. Okay? It's going to be. This is not going to help you understand the probability of default or whether your friend is going to give you your loan back. That is not going to help you because your friend does not issue bonds. But if your friend issues bonds, I can give you the risk neutral probability of default also. So for that, imagine this. Let's go to Greece. And imagine I'm going to assume a zero coupon bond so that we can do these things very easily on the screen with very simple calculations. Let's say that I have a zero coupon bond, Greek bond, with a certain spread over a German risk-free bond. And the spread is something that we observe, right? We observe because we know the price of the Greek bond and we know the price of the German bond. And I'm going to assume a certain notional N, which it could be $1 or $100, doesn't matter, you pick. It has a probability of solvency after 1 year equal to Q. That's the number we're looking for. We don't know this number, but okay, we're going to look for that. And it's a risk neutral probability of solvency. And in fact, I'm going to make this were so powerful that I can make my example very realistic. In fact, I want to introduce a new term, which is the recovery rate. When someone defaults, does not just default. When someone defaults, typically you have access to some recovery. I'll give you a simple example. General Motors defaulted, went bankrupt in the year 2008. They had bondholders, they had creditors that had lent them money. When they defaulted, these creditors didn't just disappear. They actually had access to some of the securities of the company. In fact, the company was restructured. So if the company owed you $100, you didn't lose $100. Maybe you lose $20, maybe $50, maybe $70, but it's rare that you lose everything. It's rare. It happens sometimes. Blockbuster, that you don't even know what the company is, but Blockbuster, when they defaulted, they lost everything. But normally you get access to some recovery. When countries go bankrupt, they also is typically some recovery. They renegotiate the debt with the creditors, hoping they will lend them money again. So instead of just giving nothing back to them, they give him, like 50 cents in a dollar, for example. Okay, that's a typical recovery rate, 50%. But I'm not going to speculate as to what that number is. I'm going to call it R. So R is a number between 0 and 1. It's another very important element in any discussion on credit risk, which is what is the probability, what is the recovery rate, either expected or factual. What is the recovery rate? For us, it's going to be a number between 0 and 1, and it's going to be expressed in percentages, the value of the money that is owed to me that will be paid to me. I'm not going to lose everything. I will lose something. I want to call that R. Okay? And we can assume R is 50%, or just rated R is up to us. So a Greek bond, notional N, risk neutral probability of solvency in a year called Q. I remind you this is the same. So you see what a simplified model this is. The probability of solvency of Greece in the year 2015, I'm assuming is the same as today. In 2015, everybody was talking about Greek defaulting. Now no one is talking about Greek defaulting. So clearly the probability of solvency now has gone up. Not in my model. In my model, I assume it's the same, because it's a very simple model that I'm going to use for intuition purposes only, not for calculation purposes. Okay, so let me continue with this. Make sure you remember all the terms that I have here: the notional N, the probability of solvency Q, and the recovery rate R, or 50%. So with that in mind, let's now price a bond, a Greek bond. So we have a cash flow valuation formula that we've seen already. Since it's a zero coupon bond, it contains only two terms. One term is what we saw earlier, which is what I get paid in the case of no default. I will get paid my notional discounted to, say, a year, times the probability of solvency in a year. We've seen that. That's how I started my discussion today. But then if there is default, I'm not going to lose everything. I'm assuming I get some of it back. So with the probability of 1 minus Q, that's my probability of default, I'm going to get back my full amount with a discount factor called R, recovery rate. So that's the cash flow valuation formula with recovery. Okay? Right. That's a theoretical formula. But now let me go to the market. Let me go to the real market. And in the real market, I have German bonds and I have Greek bonds. The German bond will give me R. The Greek bond will give me H. So these are numbers that I know. I know V, I know R, I know H. The first cash flow valuation formula, there is numbers that I don't know. Q, I don't know. But in this one, I know everything because everything is in the market. E to the power R comes from the German bond. E to the power R minus R plus H comes from the Greek bond. Okay? The first formula I don't know, the second I do know. So I use I use the second formula to solve for the probability of solvency from the first equation. And that's what I get. I hope this is clear to you. I'm just solving a system of equations. And when I solve the system of equations, what I get is this very nice, simple expression that tells me the probability of solvency of my counterparty country is E to the power minus H minus R divided by 1 minus R. I'm going to pause here. This is not magic. Does everybody understand how to go from the first equation to my probability of solvency?
Yeah, sure.
Everybody?
There's a risk neutral probability of solvency, right?
Hmm?
Risk neutral probability of solvency.
This is the risk neutral probability of solvency, yes. Yes. But what's important, what I want to know is that everybody understands how to obtain this from that, using that. You plug that in there, so V is gone. And in this equation, you have, what variables do you have in this equation when you do that? You have n cancels out, all n's cancel out. E to the minus r, they all cancel out. And you have q, r cube, and e to the h. You obtain that. Okay? Okay? There you go. This is fantastic, because this tells me I can calculate the probability that a country defaults only knowing the credit spread. And the credit spread is published. And note one thing, this is the probability of default, which is risk neutral because it comes from market prices. So I've just shown you in this simple model how to calculate the probability of default of a country. In fact, that's probability of solvency, this is probability of default. In fact, note one thing. Imagine, for a minute, imagine, okay, I hope this is understood, but let me show you how powerful we are. If recovery is 0, very simple, then the probability of default is e to the minus h. If you apply Taylor expansion, one minus e to the minus h, sorry. If you use Taylor expansion, this is approximated to h. So the probability of default is approximately the same as the credit spread if there is no recovery. That's how simple this model is, and that's how intuitive it can be. With this model, we can develop very good intuition about default, probability of solvency, probability of default, spreads, and all of that. It's a very simple model, but it's very, very intuitive. Okay? Okay, so let me move on, because now, just to show you how powerful we are, let me take you to another situation. Let me describe the Eurozone in the year 2012. In the year 2012 is when I told you Europe was a mess, was a financial mess. There was a lot of toxic assets that the banks had bought. The toxicity was a mixture of two things. First was some garbage sold to them by the US banks, and the other was some politically induced transactions that many banks, especially government-controlled banks in Europe, had done. There was a combination of two things, but that's not relevant for us. The relevant for us is that Europe was a default mess in 2012. And what I have done here is I've collected the observed credit spreads of the different countries with respect to Germany, and then use that to calculate the probability of default using exactly the same method we just developed here in a very simple model, okay, in my very simple toy model. So on May 2012, Spain had a credit spread of 419 basis points, 4.19%, which according to our calculation and with a 50% recovery rate assumption leads to a probability of default of 8%. There you go, you can calculate that. Portugal had a probability of default of 17%. France had a credit spread of 135 basis points, leading to a probability of default of 2.7%. You can calculate now the probability of default of just about anything with a bond. That's how powerful you should feel right now. It's a very simple model. Of course, the answer is not exact. It's not even accurate. It's just, but intuitively, is correct. The intuition you would get from this model is correct.
Is that the spreads compared to U.S. rates?
No, Germany. See, if you use a different country as your point of reference, then you have to modify this slightly, but in a fundamental way, because you don't have the luxury of using the same currency. You have to use a different currency with a different interest rate, and then you have to use a forward exchange rate between your country and the United States, if that's going to be your target. The principle is the same, but you have to change currencies and change interest rates, and that makes it a little bit more sophisticated. Okay. Great. So we have developed a model, simple model, intuitive, but very powerful to draw conclusions. So let me now make it complete. Let me take that simple model and make it complete. And now I have to tell you how a Markov chain works, what a Markov chain is in general. So a Markov chain is, again, a description of something. In this case, it's a credit condition, a description where my counterparty is in a certain number of fixed credit states. And in this case, I assume 2, but now I'm going to say, no, I'm going to make my model better. I'm going to assume n, whatever n is. For example, 8. In some of these credit systems, we have 8 credit states. You can have 16, 24, or 100. It doesn't matter. N. When you have n credit states, then a counterparty is going to be one of the n. And it can go from one of those credit states to another on an annual basis with a certain probability. That probability we write down as a matrix. So in this matrix, what I have is the probability of going from one state to another in a year. If I have n states, I have n squared possible paths that counterparties can have. From one of n credit states to another one from n credits, that's n squared. So write that down as a matrix. Where each entry here, Pij, is the conditional probability of changing from state I to state j. That's the transition probability matrix of a Markov model. Note certain characteristics of this. One characteristic is that the sum of all the entries in every row equals 1. Why? Because in any credit state, you have to go to one other credit state. So the probabilities have to add up to 1. The sum of the columns doesn't have to add up to anything, but the rows need to add up to 1. So this is the Markov matrix A, and this is the Markov matrix that we've already encountered before. It was Q, 1 minus Q, 0, 1. That's the one we used earlier, but now that I have more than one credit state, I'll have a number of entries, and this matrix is the one that matters, it's the one that will govern what I'm doing. Now, what are credit rating agencies? Credit rating agencies are agencies that place you in your bucket. These are agencies that generate credit ratings for counterparties. In fact, not just for counterparties, but for credit issues of counterparties. Each counterparty could have different credit ratings because different bond issuances could be different from each other. Moody's Investor Service, Standard & Poor's, Fitch, Dutton Phelps, Dominion Securities here in Canada. You may have heard some of these names. These are agencies whose business is to provide credit ratings to their clients. Okay. Now let me ask you a question. Who pays these agencies? The investors who buy. Yes.
Yeah, right. The party who issues the bond.
Exactly. some people think that it's the investors who pay them. No, it's the one who issues the bond that pays them. That's an interesting situation, right? Wouldn't you think that if the bond issuers pay the companies, there's a conflict of interest, and the companies would be encouraged to maybe pay more for better ratings?
I think this is what happened in 2008, right?
Okay, so that's an interesting opinion. Let me switch to a different situation, so we understand all of this. You know about universities. In universities, we give ratings to our students too. Who pays universities? The students pay.
Students?
The students pay. Yeah. So is that a conflict of interest?
No.
Well, it could be. It depends how you run your business, right? A university could decide that if you pay me enough, I give you a degree. You could do that. And maybe some universities do that. But other universities will not do that. This is part of the what's called the reputation of the university, and it's the same thing about the reputation of the credit rating agency. So it is a business which is, in a certain sense, conflicted. And if it works, it's because of the interest of credit rating agencies and the investors to respect or to uphold or to trust the ratings given by these agencies. So yes, it is a conflicted model. At times, like in 2008, it comes into question. What happened in 2008 was not so much that agencies just gave good ratings because they were paid to do that. What happened was slightly differently. What happens is that the ratings need to be published. They need to be public. So when you are going to give someone a rating, you have to say why. And because of that, because they're public, companies found a way to change their accounting statements so that they would fit into the good credit ratings. It's as if I publish my exam and then you all do very well in the exam because I've told you what's going to be on the exam. That would be the similarity. Of course, this thing came into question in 2008, and it's a very interesting discussion, but now you know a little bit more about that. Now, if I use the S&P rating system, S&P has a number of different rating levels, AAA, AA, BBB, which are called investment grade. This is what most investors will accept as recoverable or good investing. Then double B, single B, triple C, and then D, of course, default. This would what's called non-investment grade or junk bonds. You see now how important it was for Goodrich when it went to the downgrade of triple B minus. That is just one step away from a double B from losing its investment grade status. Okay, so all right, so but that's not so important for us. This is important for people running their business. For us, what's more important for the modeling perspective is the transition probability matrix that comes from a rating system. A rating system has with it a transition probability matrix. And this is what matters to us because this is what allows us, as I'm going to show you, this will allow us to do calculations of probabilities of default and this and that. So I have a matrix here in front of you. This is the S&P transition probability matrix. It's not the one that is in effect now. It's the one that I got a few years ago, which my comment deserves a footnote, which is I just told you that my transition probability matrix is constant. It's never going to change over time. And now I told you that this is a matrix from a few years ago and now it's different. Am I being inconsistent with myself? And the answer is no. The fact that I say that this matrix does not change is that my model assumes the matrix is the same. but I will calibrate my model differently today, tomorrow, or next year. So my calibration exercise may yield a different constant matrix. The things that this matrix no one really knows what it is. You can only get a calibrated version of that, but you don't know what it is. We still assume it's constant. Now, the matrix has no particular symmetries except, as we showed, the sum of the numbers in each row adds to 1. It has to do that. And other than that, there is no monotonicity or anything like that. It's expected in the rest of the entries of this matrix. You can see that the diagonal is the biggest entries in each column. What that means is that for every company, the most likely outcome is that it stays the same. Most companies, the probability that they stay the same is bigger than changing into any other level. We can observe that from that. There's an interesting comparison between two entries, the one which is from B to AAA and from CCC to AAA. And it seems here that the probability that a company gets upgraded to AAA is higher if the company is just above bankruptcy than if it's at level B. This is, for example, a surprise to some people. It's not so much of a surprise if you think about that in a different way, which is many companies, when they're established, they get a triple C rating because they have no history, they have no, probably just very weak economics. But then they become AAA very quickly. Whereas a company that is rated B, it's probably been around for a while, it didn't manage to go higher. So the probability that it goes to AAA is actually less than the whole collection of companies rated on triple C, because all the great companies of the future start at triple C. They maybe never go through B, for example, right? So that's one possible explanation, but it would be, I'm sure there's others, but even these explanations are just not interesting. Maybe they are interesting if you are S&P and you are in charge of producing this matrix, but you're very consumer, this is not so important to you. This matrix is just given to you, and then you just work with it. So when you work with it, how do you work with it? So to work with it, I need to explain a few things to you. The first thing is I'm going to tell you about long-term transition probabilities. I've told you about the transition probability matrix, and I repeat, this was a one-year transition probability matrix. But we've already seen that to do proper credit calculations, we need to know transition probabilities in 2 years, in 3 years, 1.5 years, 6 months, even 1 month. How do we do that? So let me start by going to the easy part, which is what happens after, say, 2 years. If my 1-year transition probability matrix is called A and has numbers P, I, J, then if I want to know what is the probability of transition in 2 years between I and J, what would that be? Well, between I, in 2 years, I will have to go through an intermediate year, 1, where I will be in a credit rating called K, and K could be anything between 1 and N. And the probability to go from I to K is PIK. And then the probability to go from K to J is PKJ. So I have to multiply the two because these are conditional probabilities. And I have to sum over all of the possible choices of intermediate positions, which is K. So this expression that you have here in front of you is the transition probability in 2 years of going from state I to state J. But you may remember that this is exactly how you multiply matrices. This is exactly the elements in my transition probability matrix. Sorry, this is exactly the entries of the matrix A squared. Not so surprising that the transition probability matrix for 2 years is the transition probability matrix of 1 year squared. We already saw that with solvency numbers. The same expression is not translated to matrices. what would be the transition probability matrix after n steps, say 30 years, for example? Well, it's a to the power n by exactly the same argument. And now, what would the transition probability matrix be in a quarter? Well, it will be the matrix a to the power a quarter. Or if you take any other period represented by any real number, integer or fractional, doesn't matter, the transition probability matrix will be a to the power alpha. And now I have a question for you. How do you do that? How do you calculate a to the power alpha? What is a to the power alpha? Has any one of you taken the square root of a matrix, for example? Have you ever taken the square root of a matrix? I guess that means no.
Recently.
Hmm?
Not recently, probably.
Not recently. Okay, well, so there are several ways to take square roots of matrices, or several ways to raise a matrix to a fractional power. There's several ways. Some of you may have seen that when you studied linear algebra as an application of eigenvalues and eigenvectors, maybe. If you saw that that method only applies to matrices that have eigenvalues and eigenvectors, or that can be diagonalized. Markov matrices are not symmetric, so maybe they cannot be diagonalized. So that's perhaps not very useful. Another way to take fractional powers of matrices is to use Python. You ask Python, and Python will give it to you. That's perhaps the most practical answer. But somewhere in the middle is, how does Python do it? So let me show you how Python does it. This is a formula which is perhaps not surprising to you because it's the Taylor expansion of the power. You have seen this formula where when a is a number, this formula is true when a is a number. You have seen it. It's an application of Taylor's expansion. Sounds familiar?
Yeah.
You obtain this by taking the power 1 minus x and then just do the Taylor expansion around 0. So that's what it is. Or you take the power x to the power alpha and you do the Taylor expansion around 1. And this converges fairly fast whenever the number a is less than 1. Fairly fast. So if this expression is true for numbers, is it true for matrices? And the answer is yes, as long as matrices are smaller than 1 in a certain metric. Okay? And the thing is that Markov matrices exactly meet that characteristic, exactly meet that property. Okay, so this will be true, and Python will use, by the way, this expression converges very quickly. You don't have to do infinite sums, you only have to do a few. And Python will use something like this to get you the fractional power of the matrix very quickly. 5 steps, maybe that's all it takes. Then the factorial number down there makes this series converge very quickly. Okay. All right. So you've been now empowered to do calculations with matrices so that we can build credit risk models very efficiently. All right. We have climbed a very high mountain right now. The landscape from here is wonderful. Very, very good. I want to perhaps spend the rest of my lecture today with that. The first thing I want to do is I want to show you an exercise. It's something I'm going to give you 5 minutes, so you try this and then we take a break, and then I'll come back with the rest of my lecture for today. You have to multiply that row against that column, and that will give you the probability of default in 2 years. Great. Okay, so the way a Markov model works is you have a credit rating at time 0, you are there somewhere, and then credit migration will take you somewhere else. Where, we don't know, but that position vector for you is given by a vector with probabilities which are known. They are given to us by the rating system. And after n times, we have a credit migration, which is the multiplication of different powers of the matrix A to higher and higher integers if we take it integral steps. And that will give me my position after n times. This is a framework that gives me credit traits as probability distributions that change over time. When a probability distribution changes over time, that's called a stochastic process. And at some point soon, I'm going to give you the mathematical theory of stochastic processes and how we deal with that. This is a very good example to keep into account when I give you the mathematical formalism. The mathematical formalism is there only so that we know what we are doing when we're doing all these calculations. Okay. There's some considerations why this works. The first is that the determinant of the matrix, the Markov matrix A minus the identity is 0 because the sum of the columns is equal to 1. Therefore, if I subtract the identity matrix, I get 0. So the determinant of that is 0. That means that there's always a 1 eigenvalue. There's always an eigenvector with eigenvalue 1, always. And this is the default state. We know that this is, and it's an attractor, which means every state eventually converges down to that. If I give you a matrix, which is like, for example, this one over time, you can see how the different ratings will evolve over time. And the time evolution, as you see, this is the evolution of time over fractional time, not just integer time. We can see how the A rating moves over time and how the B rating moves over time. Okay. And eventually everything moves to default because the one eigenvector is an attractor. Every state moves to default. All of these are mathematical characteristics of this particular type of stochastic processes or Markov chains with this particular matrix. Now here, this is a topic which was one of the great victories, great developments of the 20th century mathematicians. It's something very sophisticated. I'm not going to be telling you about this. This is my last slide. I just want to tell you where this ends up, and it's a very beautiful and powerful topic. When I talk about my stochastic processes lecture, I will be touching on some of these points from an abstract perspective, but I want you to see them here from a practical perspective, which is that a way to think of the matrix A to the power t is the exponential of t times the logarithm of the matrix A. Just that we can take powers of matrices, we can take logarithms of matrices, we can take exponentials of matrices. All of these things, everything we've done with numbers can be done with matrices under certain conditions. And basically, we could also have differential equations with matrices, where the derivative of the matrix A to the power t is the logarithm of A times A to the power t, just as if they were numbers. A lot of these things which work for numbers work for matrices too. Which means that the evolution of the time-dependent process A to the power t is given by this derivative at 0, which, as you can see, is independent of t. And the theory of differential equations that Newton designed is the theory that Kolmogorov reinvented to understand processes. So stochastic processes behave like differential equations because of this matrix formalism developed largely by Kolmogorov. This works as long as AT is a Markov process. And the derivative of my macroprocess at time zero is what's called the Kolmogorov infinitesimal generator. Think of that as the velocity in Newtonian mechanics that tells you how a particle moves. In this case, it tells us how a stochastic process moves. So stochastic process is the probabilistic extension of Newtonian mechanics to stochastic states. Okay. There are some relatives of this number or entity or quantities that some other courses at the FIM program may bring up to your attention. I want you to know that they are related to what I just described here today. I am fairly confident that you understood everything I said today. I'm also fairly confident that some of these advanced topics, they may look very esoteric and mysterious to you. I want to make the connection so you see that what I talked about and these topics are very related to each other. There are three special equations here. The master equation, which governs the time evolution of the probability distribution of the system. The Fokker-Planck equation, done by two physicists, Fokker and Planck, describes the evolution of the probability distribution of a continuous stochastic process. You should know that the theory of stochastic processes applies also to quantum mechanics. That was the big discovery of the 20th century, that particles are probability distributions, and therefore their evolution is given by things very similar to Markov processes. And then the Langevin equation, which is a description of random processes like Brownian motion, but in its greatest generality. We're not going to see anything about the Langevin equation. We are going to see the formalism of Brownian motion, which I will give to you shortly. We are beginning to be ready for all of that. We're ready for the formalism of Brownian motion. We're ready for the formalism of stochastic processes and probability distribution. So all of that will be coming.